Okay. Hi, I'm Peter Rose, founder of Longwood Currency Trading. A Forex trade I shouldn't have made. Jesus. As Jesse Livermore said, the only way to get an education in the market is to invest your cash, track your results, and learn from your mistakes. Oh, man. The Forex trade that I shouldn't have made was done after I made a successful trade. I did a quick scalp. I made 600 bucks. Actually, I was 900 bucks up, made another trade, lost a few $100. Anyway, I'm 600 bucks up. And life is good. And the charts showed everything was okay, and I should probably be fine in making another trade or 2 or 3 trades, because there was plenty of volatility there, and I was going in small and then coming out. And there was an opportunity there for a fairly good probability that price would have a longer run than the normal little volatility spikes that were going on at that particular time. And I thought, okay, I'll put some limit orders in here and we'll see what happens. And they got hit. And all of a sudden, price went in the wrong direction. Well, I'm in the process of putting these orders in, so I hadn't fully established my trading position yet, so I didn't have my stop on because I was adding these orders in, and price just went, it took my orders and boom, away they went. I'm, like $1,000 down, and I'm going, Jesus, what happened here? I'll tell you what happened, is that I wasn't paying attention to the economic news, the Forex economic news. Because if you've listened to my videos, I'm a strong opponent of trying to study the fundamentals of the market as far as news goes, and trade against that news. Stuff like a country is considering changing their interest rates, or they're looking at decreasing their production output of wood to the economic community, or something like that. That's fundamental news. Maybe you don't pay any attention to that, because it takes a lot of time for that stuff to work its way through into a market as large as the Forex market is. We're looking at $6.7 trillion a day of liquidity, which far surpasses the combination of all the stock markets. So it just you can't keep up with any of that stuff. It takes, you can't time it, because it's like a big cruise ship or a big oil tanker, and all of a sudden somebody goes, oh, there's a boat in front of us, and throw the wheel over, Bob, and we'll swing the oil tanker out of the way. Doesn't work that way. It could take a half a mile to get that boat to start to turn. And it's the same with these economies. You can't just say, well, we're going to do X, Y, Z, and all of a sudden that's immediately reflected in the pair pricing that's going on between that country and other economic partners of that country. However, that's a different kind of news than economic release news, like non-farm payrolls, producer price index, consumer price index stuff. And it's the producer price index that I got caught with, because I had just got done in discussing with someone why not to think about fundamentals, why not to just put it out of your head, and you trade order flow and price action, and you're aware of the conditions in the countries, but you can't trade fundamentally. And I stand behind that. I don't think you can. I mean, I look at that stuff because I'm interested in it. It's fun. It's exciting. Macroeconomics is exciting. It's about as exciting as watching the grass on a golf green grow. It's but when you understand the nuances of it, it does become very interesting, and some of you, I'm sure, are interested in that. You just can't go and make a make a trade decision based on that, unless you're thinking about carrying the position for several weeks or several months, and you're willing to withstand these large drawdowns. Well, if you're trading a couple of $1 million account, you could probably have part of your account as a position trade, and then you trade normally. But if you're trading with less than, I don't know, I've traded mid six-figure level strength on accounts, and you don't want to carry those long term. They're not large enough where you would want to withstand large drawdowns or go through that. It's much easier to take a 10 or 20 pip or 30 pip profit target and manage that trade and be done at the end of the day and protect yourself from the stupid crap that I got involved in because I wasn't paying attention to the economic news, which was a producer price index release that day. Just as I was placing my trade thinking, oh wow, I've got this opportunity for it to go in this particular direction. That particular direction was based on all the normal types of conditions that you check in your rules to determine whether your thing is good. But one of the other things that's kind of implicit within those rules is you don't want to be doing something in a vacuum when you have non-farm payroll coming up or producer price index coming up on that day. You can still trade it. I traded the last non-farm payroll and I made, I don't know, what did I say, $3,400. I think I did a video on that. So you can make money if you're aware that the news is going to come out and why that particular economic news as opposed to fundamental news will in fact directly and immediately affect order flow. And so I should not have been in there farting around. Even the quick little scalpings that I was doing, because my mindset and rule conditions would have been different had I been conscious enough to realize that today was the release of the producer price index numbers. And that caused a 30 pip jump in the price. Yeah, it came back down 20 pips, but it's still sitting at a loss of a couple of $1,000s. I don't. That kind of news generally isn't sustainable. All as far as the price goes. What happens is that there are a lot of people in there that are making bets on where that NFP, PPI, or CPI news is going to affect the market and take it. And 50% of those people are going to be wrong, right? This is a zero-sum game. It's a unique market. And so when 50% of them are wrong and it goes 20 or 30 pips against you, those people are bailing out of their trades at the 10, 15, 20 pip point, and it just feeds the fuel, and it goes, you could go 60 pips before all the people that are on the losing side are out, and then price will come back 50% because those 50% aren't in there getting rid of their positions. And that's where you get those retracement back. So I got caught in that. It went way against me. It went more than a couple of $1,000s against me. It was $4,000, $5,000 against me. And I'm just going, well, what's causing this? I went out and checked the economic calendar and go, oh, I'm in the middle of a PPI release. You dumbass. So I'll just sit here at 5K loss because I should be able to trim that about in half. And it did. Came back. It was around 2,000, but it didn't go back the other way because those releases tend to be so jarring to the order flow that most of the folks that get caught in that sort of trade are out. And it's the normal transactions that are taking place in the large institutions, the hedge funds, and all the other folks that are going, all right, we just hit a speed bump here, so we'll just slow down for a little while, and then once all the shit glitter clears, we'll go back to our normal economic activity between buying and selling currencies between all these clients, countries that we have that are placing orders. And so it takes a while for order flow to reestablish what the intent of the people that are driving the market, which is the large institutional traders, what their intent is, what their needs are. They're still holding. I mean, producer price index in the U.S. comes out at 8:30 in the morning. Well, the rest of the world is at different time zones and stuff, but the U.S. is the dog in all this stuff. And so you flush all that stuff out, and the guys that are trading USD-based pairs, which is 90% of the majors, that do 85% of the volume of that Forex market, they're just sitting there going, oh, we see this speed bump coming, so we're just going to sit on the sidelines today and have coffee. That's what I should have done. Sit on the sidelines and have coffee until after the event takes place, or if I'm aware of what's happening, have my finger on the button, trade small, trade often, go bang, 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 out, and trade around it. I can do that. I'm aware of how to do that. But you can't trade under the conditions that you are looking at the chart prior to a economic release and have any kind of a clarity as to where that price is going to go. I'll tell you where that price is going to go. It's going to go every fucking where. And it may not come back to bail you out that day. And so I'm sitting then at that point with a carry trade, because I'm not going to get out with just because I'm a couple of $1,000 down. Remember, I'm trading a six-figure account, so a couple of $1,000s isn't that much. That's maybe a trading day's profit that I would have. So I'm doing, if I'm a 65 trader, win-loss trader, 65% win, it'll take me 2 or 3 days to make that up, or whatever. That's just the money management part of your risk management component of your trading plan. So I'm not going to sweat the fact that I lose a day or 2 days of trading profits. But I don't want to prematurely get out because I made the trade based on how I view the conditions of the flow of the market, the order flow, the probabilistic calculations that you do in your little brain, kind of in an intuitive manner, to say, oh, I think I have a profit target here. So my profit target that I had established is still there on my chart, and I'm way above that, and way above my average price value as far as where the current price is. So I'm still a couple of $1,000 up, and I'm going to carry that through until the next week, where we don't have quite any Monday economic news releases that's going to impact that, and we'll see what happens. Now, when the market opens, there could still be some people that got caught and stayed with it to the end of the day and carried over, and they go, I don't want to take that chance, and they're going to be bailing out at the open on Sunday. I'm on the East Coast U.S. time, so 5 o'clock when the market's open, there might be some chatter going on, but we'll just hold through that, hold through the Monday morning U.S. New York open time, 7:30 in the morning, and let's take a look and see where the market sits at 8 o'clock or 8:30 to try to evaluate what I'm going to do with that. If that loss is at 4,000 or 5,000, maybe I'll just bail out at that time, and it'll take me 6 days to replace that money. Or maybe it'll start to flutter and it'll start to come back in the direction that I projected it to be in. If it does that, I've got a couple of other places where I want to add more lots to that position, because that was my plan in order to do that, which raises my average, changes the average position value and pulls it further away from where my profit target is, which equates to more dollar potential in there. And this particular trade, because I think that the price momentum and the order flow should take it pretty far, is one of the further out profit targets that I would normally set. You know, I generally won't get in a trade, even a scalp trade, unless I've got 10 pips or 15 pips, and I'm certainly not going to get into a day trade unless I have 25 to 30 pips of room to go. This one has about 45 or 55 pip capability to go, and I'm set out there about 30 pips or 25 pips, I think, as a reasonable point that I think that price will get to. So when it all shakes out, if that comes to fruition, or even if it doesn't quite make that point, the value of the gain that I will make is more than where my current loss position is. And of course, as the position improves in my favor and price moves more closely to where I get to a break even, I'll throw a stop on there, so that if somebody pukes and sends that thing flying, you know, I'll just get out and I'll take a $400 or $500 loss or an $800 loss or whatever that's going to be on a normal stop out, and then I'll continue on my trading. The problem with doing that is I will have lost basically 2 days of trading, where you look at my average win value, and that's a certain number, and so I've lost 2 days of potentially getting that number by not paying attention to the economic news release timing, such that I had to do a carry trade. Now, I don't normally do carry trades. I'm a day trader, so I want to be flat at the end of the day. But sometimes you have a good position, you've got a runner going, and you're trailing your stop. You just let the thing float, and that's fine. You have to be flexible enough to do that. You have to know how to do that and when to make that transition. But more often than not, I'm not going to do a carry. And because I normally don't do a carry, that's why I say because I've carried now for 2 days. I'm losing the Friday, and I'm losing the half a Sunday, and then all through into Monday. So 2 days of potentially trading on a day trade basis or a scalp basis and making $1,000 or whatever to add to wherever this major point is that I'm going to be at. There's a loss there. There's a value lost in not paying attention to the stuff you need to pay attention to. Fundamental news, I don't pay attention to it. But I do need to remember to pay attention to the economic news, and then I wouldn't have a Forex trade that I shouldn't have made. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.